Good morning, everyone. Today, we're going to challenge some deeply ingrained assumptions about managing multi-generational family wealth, particularly when it comes to the critical responsibility of supporting aging parents. In my 3 decades of managing institutional capital, I've observed a consistent and often devastating pattern. Even sophisticated investors frequently apply generic retail retirement tools to complex, long-duration family liabilities. This conventional wisdom, saving cash, buying low-yield bonds, or relying on notoriously inefficient long-term care insurance, is mathematically flawed. It treats a complex, multi-decade financial challenge as a simple, short-term liquidity need. This approach leaves families vulnerable, eroding their financial foundation instead of strengthening it. We need a fundamental shift in perspective to truly secure the well-being of our loved ones. The primary risk we face isn't merely longevity itself. It's a far more insidious and often overlooked factor we call the medical inflation spread. This refers to the historical trend where the cost of specialized senior care consistently rises 200 to 300 basis points faster than the Standard Consumer Price Index, or CPI. Think about that. If CPI is at 3%, medical care costs are soaring at 5 to 6% annually. A standard SAFE portfolio, perhaps yielding 4% from conservative bonds or general savings accounts, is actually losing purchasing power relative to the very liability it's meant to fund. You're effectively going backward, fighting a jungle war against accelerating costs with what amounts to a pea shooter. This gap is a silent killer of financial plans, eroding capital year after year. This brings us to the counterintuitive yet profoundly effective solution. To secure your parents' well-being without jeopardizing your own financial footing, you must fundamentally shift your approach. You must stop merely saving for their care and instead start investing in a dedicated anti-fragile care endowment. The concept of anti-fragility, popularized by Nassim Nicholas Taleb, describes things that don't just withstand shocks, but actually benefit from them. In this context, we need a financial mechanism that doesn't just survive economic volatility and medical inflation, but actually strengthens and expands its capacity precisely because of these pressures. This endowment becomes a self-replenishing well of liquidity, transforming a depleting burden into a growing asset. To build this anti-fragile endowment, we need a specialized framework. We aren't simply looking for general investments. We need assets that don't just survive inflation, but actively thrive on it, specifically healthcare sector inflation. This isn't about chasing volatile biotech stocks or speculative pharmaceutical ventures. Instead, we're looking for the picks and shovels of the longevity megatrend. These are the foundational businesses and services that possess inherent pricing power, a critical attribute in an inflationary environment. Our proprietary Silver Economy Cash Flow Matrix screening framework is designed to identify these unique opportunities, focusing on stable, revenue-generating assets within the growing senior care ecosystem, ensuring consistent cash flow and capital appreciation. Our proprietary screening framework focuses on 3 non-negotiable criteria, the first of which is essentiality and inelastic demand. We are seeking services and products that cannot be easily cut back or eliminated even during economic downturns or recessions. Consider services like skilled nursing facilities, dialysis centers, or specialized rehabilitation hospitals. These are not discretionary expenses. They are absolutely critical for the health and survival of an aging population. Their demand remains consistently high, regardless of the broader economic climate, creating a robust revenue stream for the underlying businesses. This inelasticity provides a powerful defensive characteristic to the endowment, ensuring that its core assets continue to generate income precisely when other sectors might be struggling. The second and third non-negotiable criteria are vital for combating the medical inflation spread. First, we look for inflation-linked revenue escalators. This means assets whose contracts include built-in clauses where revenue automatically increases with CPI or a fixed annual percentage. This allows the business to pass rising operational costs directly to tenants or insurers, ensuring that your income stream keeps pace with inflation rather than being eroded by it. The third criterion is the double compounding dividend. We target companies that consistently grow their dividends faster than medical inflation, ideally targeting 7% or more in annual dividend growth. This creates a powerful, expanding income stream that accelerates precisely when care costs are also escalating, effectively turning the inflationary headwind into a tailwind for your endowment. While general healthcare equities might seem appealing, the most robust application of this anti-fragile framework is not in broad healthcare stocks, but in specialized healthcare real estate investment trusts, or REITs. Specifically, we focus on those investing in triple net lease medical facilities. This niche offers unique advantages. Unlike direct healthcare providers who face regulatory and operational complexities, these REITs own the essential physical infrastructure. They lease out properties like medical office buildings, specialty hospitals, and senior living facilities to healthcare operators. The triple net lease structure means the tenant is responsible for property taxes, insurance, and maintenance, significantly de-risking the landlord's position. You're investing in the very foundation upon which the longevity trend is built. Let's illustrate the power of this alpha approach with a contrasting example during a period of rising rates and high inflation, similar to the 2021 to 2023 cycle. Consider the traditional approach, a portfolio heavily weighted towards aggregate bond funds. The result? Capital depreciation due to rising interest rates and fixed income payments that utterly fail to keep pace with accelerating nursing home costs. Your capital shrinks and its purchasing power diminishes. Now consider the alpha approach, a curated portfolio of medical office buildings and life science specialized REITs. These assets often feature long-term leases, 10 years or more, with built-in rent escalators directly linked to CPI. Furthermore, the tenants, such as doctors' offices and labs, are sticky. They cannot easily move expensive, specialized equipment. You own the essential infrastructure of the longevity trend, earning rising income while the underlying asset appreciates due to scarcity and demand, providing true anti-fragility. Effective implementation is crucial for this strategy. First, and critically, do not commingle these funds with your general retirement pot. This requires a dedicated, ring-fenced account, a psychological firewall to ensure the endowment's integrity. Second, define your accumulation runway. Ideally, you should start building this endowment 10 to 15 years before the anticipated peak need for parental care. This extended timeline is paramount. The goal during this period is to achieve escape velocity, where the portfolio's dividend growth consistently exceeds medical inflation before any significant drawdowns begin. This allows the endowment to become truly self-sustaining, generating income that outpaces costs, turning a potential financial drain into a powerful, compounding asset for your family. The final steps in our implementation strategy involve precise filtering and aggressive reinvestment. Execute the silver screen. Filter for companies with a proven track record of 15 or more years of consecutive dividend increases, demonstrating financial resilience and commitment to shareholder returns. Ensure their payout ratios are under 75%, indicating a sustainable dividend that isn't overextending the company. Crucially, confirm their primary revenue exposure is to the 75-plus demographic, directly aligning with our longevity megatrend focus. Finally, and perhaps most powerfully, during the entire accumulation phase, reinvest aggressively. Establish a dividend reinvestment plan, or DRIP. This harnesses the true power of compounding, allowing your dividends to buy more shares, which in turn generate more dividends. This strategy builds a financial fortress that will stand ready, robust, and expanding precisely when your family needs it most, transforming a potential burden into an